Welcome to Go Bank Yourself, where we break down how to grow and control capital like a banker. I'm your host, Dovi Herman, joined by my co-host, Pinny Levy. Let's begin.
Welcome to Go Bank Yourself.
Go Bank Yourself.
Go Bank Yourself. Go Bank.
Joshua, Pinny, Levy, my name is Dovi Herman. Thank you, everybody, for joining us.
Thank you so much. We're going to talk about all the secrets we have, but in a measured way, step by step, revealing all these wellsprings of financial knowledge to you.
We're going to talk about money, finance, banking, because that's the epitome of finance, isn't it? Banking.
Banking. I mean, if I could own a bank and sit back and collect checks, I would do that. Would you?
I'd love to, but it would probably take hundreds of millions of dollars, investments from outside people that I don't have, and 10 to 20 years of waiting.
A lot of greasing of palms, a lot of, the politician's analogy is kissing babies, but I think it'd be more like kissing rear ends to get in line for your banking certificate or your title that you need to open up a bank. I think we have plans to talk about exactly how a bank makes money, which is a great thing to, great work if you can get it. But we wanted to focus on the qualities of the ideal place to store money, or call it the ideal investment, right?
Yes, there's an article out there and a book made up of articles called The Perfect Investment, which was ironic in the first place because what we're talking about is not an investment per se, more somewhere to store capital, save money, and be able to use that stored capital as a private banking system that person owns and controls.
Right, but at the same time, when you think of all the things that you want, and it can be made up of stuff that we've taken for granted because it's conventional wisdom. You want the market to be high, right? Or trained that you want the market or the parallel, your rate of return to be low. We want it to be high, but a reasonable person can say, okay, I want it to be consistent and better than flat. As good as it can get without being dangerous. Otherwise, we're speculative, right? We don't have a crystal ball.
You're saying somewhat high yield. Yield probably isn't the right term, but growth without much risk of loss or any risk in the ideal world.
Ideally without any risk at all. But in the real world, our brains are programmed to think that if there's no risk, it must be a boring rate of return or something that's not worth getting into. Maybe it's the Israel bond that Zadie got me when I was born. For $18, and then you come a decade later. Wow, this is worth $23 before tax.
I don't know much about Israel bonds, but my father he was in finance for a while. He was a bonds broker, and he worked for Israel bonds. He sold Israel bonds here in LA for like 10 years, maybe less, but for a while. When I was a kid, I remember that.
I don't know if Zadie Cowan from Quincy, Mass. went to LA to buy his bond, but he got me something. So. The idea is we want growth because that far we can work out it for ourselves that we want some growth and we don't want it to be flat, and we know that the higher the growth, the bigger the risk of loss, right?
Right, that's the conventional wisdom. Risk, high return is what most people think.
That's exciting but risky, but low risk, low return is boring, and who wants to get into that? So if we said somewhere in the middle, we'd be firing on all 12 cylinders here.
Agreed. But we both know that we're not just talking about growth over time. That's definitely an aspect here. We need growth for this system to work, but there has to be other unique features too. Otherwise, what are we doing talking about banking and only talking about slow levels of growth over a long period of time?
Good point. So when it really kicks in, we want to be able to do something with it. So maybe just because it's in the news, when I hear $39 trillion of debt, amassed, and my quirky memory can
the national debt, you're saying.
The U.S.
national debt.
And I recall when the debt was just a very humble 19 trillion. It was 2010 because there was some radio show where some kookball think tank proposed in a session of Congress to simply take all of the 401k holdings in America and use them to pay down the $19 trillion debt, because at the time there was 19 trillion in 401k holdings. I think that's north of 20 trillion now. And there's 19 trillion of debt. Let's just move the 401k money, the retirement money for all Americans that they have privately saved away, and put that against the debt. Now I'll have no debt. It will give IOUs to all of the owners of these 401ks and IRAs. Well, obviously that I don't even know if you can call that a trial balloon. It was shot down, but because it's complete statism.
Sure.
You're literally robbing people to pay a national debt. But when that number gets big enough, you've had other kooky plans. You know, they've talked about in the past. Why don't we just mint $1 trillion coin? And now I guess they'd have to mint 39 of them. And you know, what would you rather have, the $39 trillion coin from the U.S. government, or a 24-karat gold coin from you know, from some mint of the past?
So what it sounds like you're getting at is that eventually they're going to have to try to inflate the debt away, which is not exactly possible. That, or tax the U.S. citizen into oblivion.
That's right. Yeah, it's kind of sad because statistics show that you can't generally tax people more than a third without there being some type of a revolt. Crazy enough, I think we had a revolution over a 2% tax on tea, or raise on the tax on the
Millions of people right now are being taxed at more than 30%. Just that income. Then you take sales tax and property tax and whatever other kind of taxes there are.
So what about my successful investments? Well, there's different tax treatment. Seek a tax professional for all of your, this does not constitute tax advice. But depending on, Democrat, Republican, you see capital gains going up, going down, as low as 15%, as high as 30%. But what are you going to get taxed on your investments? Is your $100,000 growth really worth $100,000 to you, or is it worth $80,000 to you, because you have to calculate what's going to be after taxes if you liquidate? So tax treatment is very important, whether it's investments, income, or anything except that which is considered tax-free growth right now. So What do we think about that? Do we want to have taxable investments, or a tax-free, or at least a forever tax-deferred investment?
So when we're talking about building our own private banking system that we would own and control, looks like we're going for safety, no risk of loss, growth, moderate levels of growth over time, and tax-free. What else might there be? Tax-free is the way to be.
If such a unicorn existed, we would want that. When we talked about growth, did we mention guarantees on the growth? Like, you will grow by this minimum guaranteed, which, instead of giving up the guarantee for more potential, for more risk and more growth, we've settled on moderate growth with guarantees of growth in each and every year.
So safety, growth, and tax-free all sounds great. 4, 5, 6% over a long period of time sounds nice, but I can do so much better than that in my business. So why would I ever put money away into whatever you're talking about? Most successful businesses can get a good 20, 30, 40, hundreds of percent inside of their business. Of course they can. So why would I ever consider putting money into something, even if it's safe, stable, tax-free? I don't see the benefit. I'm being sarcastic, but Pinny, tell me.
I figured you're setting up a softball question. So most successful business owners do plow money back into their businesses, and God bless them. If you know that you have a run rate that produces such, you should do that. But imagine if you first parked your money into the investment we're talking about, and then leveraged it to go back into your business. Imagine if it were liquid, but at the time we're accessing or leveraging the money, we're still earning the rates of return that we talked about earlier. That'd be ideal. We're not revealing what it's called yet. So your money's doing two things. It's being a basis of this investment and still going into your business because you know that that's where you get consistent returns. Fine. I'd also add though that there is pressure to perform, and there's risk of failure and loss, God forbid. But how many businesses have failed? What happened in COVID? Maybe there's forces beyond our control where everything's going great until it isn't, where there's Sears Roebuck in every city until there isn't. So things that we take for granted financially or economically aren't always such. So
you would save and build up a pile of cash inside of this entity that we're talking about. And then when you want to go use it for, let's say, your business, you would borrow against that asset. And when you borrow against it, you're not interrupting the compound growth over time. So it's still going to grow in there like it was never touched. But you're going to get access. You're going to get access to tax-free cash and then go put that cash into your business. And when your business generates a return, because we're assuming that it will, you can take part of that return and put it right back into that loan, which replenishes that cash, and you're right back to where you were before, and you never interrupted the growth.
Right. That probably would go better with some visuals, but that is the basis of the idea, yes. What about creditor protection? Same example. Year after year, you've plowed your money back into your business, and Baruch Hashem, it worked. It's growing bigger and bigger, more assets, more higher valuation, a higher market value, and then something bad happens, and someone wants to sue. I live in South Florida. My father, may he live and be well, got rear-ended, and the person sued him like it was his fault. How could it be his fault? He was rear-ended. Guy was tailgating, obviously. It's a litigious society. So let's say a business is sued, and there's a judgment against the business owner. Can they take money out of that person's business or force them to sell assets? I believe they can. Ideally, you would want your money protected in something as financially sacred as an untouchable trust. So if this investment could encompass that feature, then all the better. And guess what? It does. Anything to add on that?
If a business owner is sued and they have a lot of their cash parked in one of these vehicles, then whoever's suing them can't touch it. Now, is that in all states? Is that
there's
that correct? Does it not go state by state?
Some states are stricter than others about protecting the cash, but all states have some protection inside this vehicle from creditors. Other features. What if you wanted to pursue a loan with a third party, and the money that's locked up in your investment here that no one can get at, no creditor can get at, you wanted to use as collateral for a loan from someone else's bank? You can do it. This is the way the investment works: is you're able to show that the proof of that money, the proof of ownership, or even assign the control of it to a third party, a bank, in order to obtain a loan from them. Maybe they have very favorable rates. Maybe they have a bank, and so the ability to use this money.
So if somebody thought that they could get a better loan structure, a better rate from an outside financial institution rather than take a direct loan from this entity,
correct,
then they could use that asset as collateral through somebody else, through a third party.
And at just about 1-to-1 a loan to value. Meaning, if you have a successful stock portfolio and you go to a third party bank and say, I want a loan, what's your collateral? Here's my stock portfolio. They say, that's great, current value 100,000. So this is worth 25,000 in collateral, about a 1-to-4 ratio. Whereas here's my $100,000 in type of investment that Dovi and Pinny are talking about. Well, great. We'll give you a loan up to $100,000 based on that value. Your mileage may vary depending on your broker or your financial advisor, but the value of your portfolio is diminished to some degree if you wanted to use that for collateral. And again, your mileage may vary, but the investment we're talking about, 1-to-1 ratio.
And when you try to borrow against the stock portfolio, margin loans or collateralizing something else, you are opening yourself up to margin calls and risk. Whereas with this preferred type of loan, what would happen if you can't pay it back for some reason? Is there any penalty there?
The truth is there's no penalty.
Any ding to your credit score?
There's not even actual repayment terms. So you may get a lower APR with some other bank, but you're going to sign and you're going to collateralize that loan either with personally guaranteed, where your personal assets are at risk, or some other structure of collateral. But you're agreeing to a repayment that's firm, and there's going to be fine print on what happens if you don't pay 1 month, 2 months, 3 months down the line. Whereas the loan we're talking about has at max a 1-page form, not an application. There's no credit check. There is no adverse credit outcome where one of the credit rating agencies is going to say, failure to repay this loan, therefore credit score is now impacted. There's no nasty grams, there's no repossession, and there cannot be a bankruptcy for failure to repay these loans, because what we'll cover later is that, in fact, you're not only the one borrowing the money, you're the one who sets all of the repayment terms. You can even choose to never repay.
So you set all the repayment terms. You are the banker in this situation. You're both a borrower because you're leveraging something and taking out a loan, and you're the banker because you are setting the repayment schedule of that loan. You're in charge of it.
So, folks, Dovi Herman has just let the cat out of the bag that when you look at this investment more as a bank that you control, that's going to really have to require us to get into some features of a bank, how banks make money, how they operate, because ultimately that's what our investment is going to do. It's going to allow us to be our own bankers. Go bank yourself. You're going to be able to control the capital you put into your bank. That comma is very important. How important is
Yes,
grammar?
go bank yourself. You have to go bank yourself. Don't go bank yourself.
That's also the which syllable you're putting the emphasis on. You have to put the emphasis
That's
on the right
right.
syllable. But I was walking with a buddy once, and there was a hike, and there was a sign in front of a nice pool of water that said "Warning: No swimming." Classic, right? So what does he say? He says, "Warning, no swimming," and he jumps right in. Punctuation is important, so don't worry about all these things like taxes and growth rates. You don't have to worry about that. No, jump right in. Well, with Go Bank Yourself, we're going to show you exactly how to build what can function for you, for all intents and purposes, like your own bank. And when you're wearing all the hats, you're the depositor, you're the borrower, you're the loan officer, and you're the fat cat owner who's going to earn dividends on this thing tax-free for your entire life if you wanted to. So we're going to have to dedicate a whole episode to that. But I think for now we can cut it and say that all these different qualities, tax preferred growth, a good rate of return, guarantees every year. What else did we talk about? The ability to collateralize, the ability to have your money do two things at once: grow inside your investment, and in our example, use it as investment or capital for your business at the same time. How do we do all these things and put them all together? That's going to be what we cover in the very next episode of Go Bank Yourself.
Thank you for listening to Go Bank Yourself. To learn how to apply these strategies in your own life, email Dovi Herman at realchangefinancial.com. We'll see you in the next episode.